Capital leases are leases that in economic substance are equivalent to purchasing an asset. So because we're in substance purchasing an asset, we are going to show the asset on our balance sheet, and we're also going to show a liability that we need to pay for this asset over time, because under the lease contract, we don't make payment immediately, we pay over time, okay? So under the US GAAP, the following types of leases are classified as capital leases. There has to be a non-cancelable lease that you cannot get out of, and it has to be long-term lease, of course, and one of the four conditions have to apply. Either the ownership is transferred in the end of the asset life, or there's a bargain purchase in the end of the asset life, like you can purchase an asset for $1, okay? So in these cases, economic substance, intuitively, you're effectively becoming an owner of the asset when you're entering a lease like this, okay? Condition 3 is that lease life covers at least 75% of the asset's useful life. And condition 4 is that present value of future lease payments exceeds 90% of the price of the asset, okay? So if these conditions are fulfilled, any of them, right, is fulfilled, this means that in economic substance, we are either purchasing or very close to having an arrangement that is very close to a purchase of an asset, okay? And we have basically a capital lease. Under IFRS, we have similar 4 requirements, but they don't use bright line threshold like 90% or 75%. It basically says if substantially all of the asset life is covered by the lease, then it's a capital lease, things like this. But, overall accounting rules are quite similar. So let's take a look at an example and understand sort of mechanics of the calculations behind the lease. So suppose we have an asset that has useful life of 4 years, and we are going to lease this asset for the entire 4-year period and then become owners of this asset, okay? So lessor, who owns the asset currently, agrees to lease the asset to us in exchange for 4 payments, right? So in the end of every year, we are basically going to pay $282, and then we can basically have this asset, okay? So accounting is going to involve capitalization of the present value of these payments, right? So we need to compute present value of each of these payments and add them up, right? And they end up to $1,000. So that's the present value. So that means that lessor would be willing to sell us an asset for $1,000 if we were to pay now, or alternatively, lessor essentially sells it to us over time. Over time, we end up paying for the price of the asset, but we also end up paying for the financing component, right? That lessor is charging us for the fact that we pay over time. They essentially give us credit, right? So we assume here that the required rate of return for the lessor, right, or the effective interest rate is 5%. Notice what's different from a typical bond accounting is that there is no par value, right? Par value essentially is 0. There is no lump sum payment in the end, okay? This would be very similar to a mortgage, right? Also no par value payment in the end. Instead, each of the payments that we make due over time is going to recover the price that basically of the asset that we are leasing, okay? By the way, the 282 amount can be easily computed using this formula in Excel, in case you're wondering how to compute it. Okay, so here you see the amortization table. We are going to start with the value of the liability that's equal to 1,000, and the liability is going to go up by the amount of interest, which is 5% times the beginning balance, and it's going to go down by the amount of cash payment that we are going to make, okay? Or net effect is going to be the amount of amortization of the liability, okay? So ending balance is going to become 768 after first year. then the interest expense in the second year is going to be already a little bit lower because we partly repaid some of the balance in the first year, and so we basically take beginning balance times 5% and so on, right? And so of course by the end of this lease we fully amortize the balance of our liability. Okay, so let's see at the accounting entry for capital lease, right? So for capital lease, accounting entries are as follows. At the initiation of the lease, when we enter the lease, we treat it as a purchase, okay? So we basically recognize an asset, leased equipment or property, plant and equipment, and we recognize a liability, lease or capital lease obligation. And then over time, we do whatever we do when we account for long-term debt, right? So we account for cash payment that takes place in the end of the first year, and we account for the interest expense that happens in the first year. And the difference between interest expense and interest we pay is going to go towards reducing the balance of the amount that we owe to lessor, right? And in the second period, the same thing happens again. We pay 282, but interest expense is of course based on our amortization table now a little bit lower, and so the plug here is going to be smaller. Over time, we fully recover this balance, right? You could also do it with approach 2, right? Remember we saw this previously when you account for interest and cash payments as two separate transactions. That wouldn't be a mistake. That would be perfectly fine as well. I mean, you have to understand that lease obligation or any type of long-term liability goes up by the amount of interest that accrues over a period, by the amount of interest expense essentially, and goes down by the amount of payment. And for leases, payment is actually quite substantial because we need to pay the interest, but we also need to repay the balance of the loan by the end of the year 4. Okay. Now, of course, another thing that happens on our accounts is that we record depreciation expense, and here we use straight line of the leased equipment. Here, for simplicity, I am avoiding the account accumulated depreciation, but of course we could use accumulated depreciation, and that would be totally fine as well. Now, notice that there's one wrinkle here, and that's different for leases versus bonds. So the amount that we are paying, 282, is essentially broken down into interest and principal reduction, right? So interest is going to be 50 in year 1, and principal reduction is the amount of amortization, right? That we essentially have in year 1. And so interest is classified as operating activity in the cash flow statement, whereas reduction in principal is going to be classified as financing activity in the cash flow statement. That's something to keep in mind. Okay, so this tells you everything you need to know about accounting for capital leases. Operating leases are going to be very similar, but with a couple of wrinkles, big picture is going to be quite similar. All right.